All right, let's talk about the psychology of money. Today, we're going to put our own, messy, emotional human brains up against the cold, hard logic of a machine. Okay, let me kick things off with a question for you. What do you think is the single most important skill for getting rich? Seriously, take a second to think about it. Is it like a fancy degree from a top university? Maybe a genius-level IQ, the kind that lets you see market trends that nobody else can? Or what about landing that big-shot job on Wall Street? I mean, these are the usual suspects, right?
Well, what if I told you it's none of the above? Yeah, the real secret to building wealth is actually way more surprising, and frankly, it's something that's much more accessible to all of us. So to get this idea across, let's do a little thought experiment. Who do you think ends up wealthier in the long run? A janitor who diligently saves a little bit from his paycheck, or a top financial executive who earns millions but somehow loses it all?
Let me introduce you to a guy named Ronald Read. His story is just incredible. You look him up, and his bio describes him as a philanthropist, an investor, a janitor, and a gas station attendant. That's not exactly the resume you'd expect for a financial titan.
But get this. When Ronald Read passed away in 2014, the world was absolutely stunned to learn he had quietly built a fortune of over $8 million. Just let that sink in. $8 million.
So how on earth did he do it? There was no lottery win, no big family inheritance. Nope. His strategy was almost laughably simple. He saved what little he could, he invested it in big, stable companies, what we call blue chip stocks, and then he just waited for decades. He let the magic of compounding do all the heavy lifting. And Ronald's story just perfectly illustrates this core idea. Your behavior with money is so much more important than how smart you are. This quote just nails it. Patience and discipline can literally be more powerful than a genius IQ.
Okay, so this gets us to a really crucial point. Why is our behavior so often, irrational? It's because our relationship with money is deeply personal. It's all shaped by our own unique story.
Now this chart shows the idea perfectly. If you were born in 1960, you watched prices just skyrocket during your teens and 20s. You learned that money's value can basically evaporate. But if you were born in 1990, inflation has been a relative non-issue for most of your life. These two people are going to have fundamentally different instincts about saving and investing, all because of the world they grew up in.
And here's the key takeaway from that. Nobody is crazy. The financial decisions we make, even the ones that look bizarre to other people, they're rooted in our own experiences, and they make perfect sense to us at that moment.
Let's take the lottery, for example. On paper, it is a terrible investment. We know that the lowest income households spend 4 times more on tickets than the highest income groups, often spending money that could be their entire emergency fund. So why do they do it? It seems totally illogical.
But you have to reframe it. As this quote suggests, for someone who feels like they have limited opportunities, a lottery ticket isn't just a piece of paper. It's the only tangible chance they might feel they have to buy into a dream that other people might take for granted. You're not buying a ticket, you're buying hope. But this whole psychology thing, it cuts both ways. On the other end of the spectrum, you find the curse of never enough. And this is the dangerous mindset that causes people who seem to have everything to risk it all for just a little bit more.
I mean, take Rajat Gupta, a multimillionaire who risked prison for insider trading just for the chance to become a billionaire. Or look at Bernie Madoff, who already had a hugely profitable, legitimate business, but he threw it all away to build that massive Ponzi scheme. They already had wealth, prestige, and freedom. Warren Buffett summed it up perfectly. They risked the things they had and truly needed, like their reputation and their freedom, for money they didn't have and didn't need. It's just foolish. This is a failure of psychology, not finance. The goalpost for enough just kept moving. So if we humans are just riddled with all these biases and blind spots, it raises a fascinating question for our modern age. What happens when we bring artificial intelligence into the picture? Can a machine actually learn our own worst financial habits? This entire conversation, by the way, falls under the umbrella of behavioral finance. It's the study of how our very human, often irrational, psychology impacts financial markets. And it's the lens that researchers are now using to examine AI. So the central question a recent research paper asked was this. Are these powerful new AI models, the same kind of tech behind tools like ChatGPT, are they prone to the same cognitive traps that we humans fall into?
The experiment they ran was pretty clever. Researchers fed an AI historical stock data. Then, they introduced a bias signal, like a strong recent trend that might trigger recency bias in a human, or maybe a fake opinion from an expert to trigger authority bias. Then, they measured if the AI's mistakes consistently followed these misleading signals. And the results were stunning. As you can see right here in this table, most of the AI models showed significant bias. Their error rates jumped way up when they were fed the misleading signals. But then, just look at that bottom row. GPT-4o was a massive outlier.
So think about what this means. While most of these advanced AIs were basically mirroring our flawed, biased decision-making, one model was almost completely immune to these psychological tricks. Its bias index was incredibly low, under 2%, while others were hitting nearly 40%.
The researchers themselves were blown away. They concluded that GPT-4o might actually exhibit superhuman performance in this context, precisely because it isn't swayed by the cognitive biases that plague human investors.
And this brings us full circle, leaving us with a pretty provocative final thought. We started with the idea that our own behavior is the biggest hurdle to building wealth. So what happens to the future of investing, and to our own financial lives, when we create an investor that has no human psychology at all?